Thank you for watching this video. Today we will be doing technical analysis on the stock market for the week ending Friday, November 13th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of experience investing in mutual funds, over 25 years experience trading stocks and options. I'm a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. This week, the S&P 500 was up 2.16%, and we closed the week at 3585.15. The first chart that we're going to look at is a 5-year weekly candlestick chart of the S&P 500. So each candlestick does represent 1 week of trading. The blue line that I have drawn here, this is the trend line on top of the peaks in the S&P 500 over the last few years. And you can see these are the major peaks. And you can see what happens anytime we hit the top of this trend line, we generally pull back to the 40-week moving average, this green line here. And you can see the last time this happened was this year, and that was in February. And unfortunately, that coincided with the coronavirus coming to the United States. And so instead of just pulling back to the 40-week moving average, which I had been warning my subscribers in January and February that was likely to happen, the sell-off, of course, got much worse. And then we had this quick rebound. Well, we once again find ourselves back up against this long-term trend line. So, and that's this week's candle right here. And we stopped almost exactly on that trend line, guys. So, the question becomes, will we roll over from here, or will we push through and trade above this trend line? Now, either scenario is possible, but statistical probabilities tell us that we are more likely to have a pullback here. Now, it doesn't mean we have to pull back to the 40-week moving average, but anytime you're trading this far above the 40-week moving average, currently we're trading over 14% above the 40-week moving average. So anytime you're trading this far above the 40-week moving average and you hit this overhead trend line, this overhead resistance point, if you will, it's not uncommon for us to pull back at least to or, towards that 40-week moving average. So I think the probabilities are that in the short term, we're probably, over the next few weeks, going to experience some type of a pullback. It may or may not happen, depending on news, right? Because we have a highly news-driven market right now with, things around the election, coronavirus, vaccines, treatments, stimulus, things like that. So good news could push the market higher. However, the lack of any positive news and positive data points, probably is going to allow the markets to roll over here and pull back to at least some of the short-term trend lines that I've talked about extensively over the last couple of weeks, so I'm not going to get into them tonight. But, the worst case scenario, I think we probably pull back to the 40-week moving average, but we'll have to see if that's going to happen. But for now, just be aware of the fact that we are trading up against this long-term trend line that has been in place since the first part of 2018. So it is it's something to seriously keep in the back of your mind here, guys. The next chart that we're going to look at is a 5-year weekly candlestick chart of the triple Qs. And just like the S&P 500, I've drawn this overhead trend line starting at the first part of 2018. And here you can see that this summer, we jumped above the trend line on the triple Qs, the Nasdaq 100. And the overhead resistance point, if you will, has now been acting as an area of support, with the Nasdaq 100, the triple Qs, running on top of this trend line. However, the Nasdaq 100 over the last couple of months has started to languish, and you can see that this week the Nasdaq 100, the triple Qs, was down 1.20%, and of course the S&P 500 up 2.16%, but the triple Qs down 1.20%. Now, this is meaningful on a couple of levels. First off, the Nasdaq 100, this is quote-unquote one of the hottest areas in the U.S. stock market. It has some of the fastest growing, highest PE, highest price-to-sales ratio stocks in the U.S. stock market. So the fact that the Nasdaq 100, which by the way has been really the leadership area this year as well as over the last few years, the fact that the Nasdaq 100 is starting to languish, is starting to underperform on a relative basis, doesn't bode well for the overall stock market in the short term. The stock market really is going to need tech leadership, large cap tech leadership, if we're going to continue to move forward and make new highs. So the fact that we're languishing here, and you can really see this on a daily chart. So I want to jump back over here for a second, and you can see that since September 2nd, that was the all-time closing high so far in the triple Qs, we've been forming this wedge, okay, on the daily chart. It's really easy to see on the daily chart. And so we've had this consolidation pattern in the triple Qs. Now, eventually, right, it'll break out to the upside, but in the shorter term, we're obviously trading above this long-term trend line, which shows us that we might be a little overdone here, and we're trading over 18% above the 40-week moving average on the triple Qs. On the S&P 500, we're over 14% above the long-term moving average, the 40-week moving average, but on the triple Qs, we're over 18% above this long-term moving average. And just like the S&P 500, you can see that in most cases, when you hit the top of this trend line, you will eventually pull back to the 40-week moving average. It happened there, it happened there, it happened there. Of course, here we went below it. Here we went below it. But the fact that we're already trading well above it, and we're stalling, and we're underperforming on a relative basis, it just shows that the markets have gone a long way in a short period of time, and may need to consolidate even further and even pull back further before we get the next leg higher in the overall stock market. So only time will tell. Again, could we continue to go higher from here? Absolutely. But in the short term, it's more likely, I think, given what we're seeing, that we'll have some type of a pullback, 5-10%, whatever it is in the stock market, which will allow the market to catch its breath before we take the next leg higher. Now, one area of strength in this last week, and a bright spot, and finally, has been the small caps, the IWM, which is the ETF that tracks the Russell 2000 Small Cap Index. This ETF was up 6.04% this week and made the first new all-time closing high in the Russell 2000 since August of 2018. That's why I have this blue line here. And any of you that have been following my work for a while, I've been using this chart over the last few months to show you the relative weakness in small caps. But this week it flipped. And so now the small caps this week were one of the strongest areas in the stock market. So this is potentially good news, as we're starting to see potentially the breadth widen out from a capitalization standpoint, because up until recently, it had really been large cap tech that had been one of the few things that was working really well. Well, now large cap tech, the triple Qs, are underperforming, at least in the short term, and small cap has, at least in the short term, taken the leadership role. So this could be a very good sign over the long haul. And you can see here from this point here at the beginning of 2018 until recently, the Russell 2000 had just basically traded sideways with some volatility. So for almost 3 years, we made no progress in the Russell 2000. And this week, we made an all-time closing high, and again, up 6.04% on the Russell 2000. So that is potentially some very good news longer term. But again, in the shorter term, guys, we are up against the long-term trend line on the S&P 500. We're well extended above the long-term moving averages. So I do think that we might be due for some type of a pullback here at least in the near term. So only time will tell, but just be aware of this. And guys, if you like my work, if you like my charting, in my Simple Market Signals newsletter, which I write every weekend, I have a lot more charts that I do not put on YouTube. These charts are only for my subscribers, and that is over and above the signals, the proprietary signals that I deliver via the newsletter. So if you like my charting, you want more in-depth charting, you want to continue to learn about the stock market, whether you're an experienced investor, I have hedge fund managers, financial advisors, mutual fund wholesalers, and new investors, people that have only been investing, just over the last couple of years. So, guys, it really helps regardless of whether you're a financial professional or a newer investor. If you're a very successful person that maybe recently retired or recently sold a business and you're running some or all of your own money, I would encourage you to take a serious look at what I do, guys, because I share a ton of information every week with my subscribers, and there's a lot of information that I do not share anywhere else that is just for my subscribers. So, and at less than $20 a month, it is an incredible value and something that I believe most people would really, really benefit from. So with that said, I'm going to tee up some more information about Simple Market Signals. Guys, thanks for watching the video. Have a great weekend, and please pay attention to the next part of this video. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. we know that we came into the year with a strong stock market. So we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February. And I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the simple market signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this simple market signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the simple market signals model, there are three powerful indicators. There's the simple market signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in this Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file. All right, so once you subscribe, you go out to the website simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend. All right. So the goal is to get it out Saturdays by 2 p.m. But it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders. Because it's probably hidden in there. All right, so you should get the automatic welcome letter, and then the latest edition within the next day or two of your subscription, and then again the standard newsletter goes out every weekend. But we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.